In this video, I want to go over 10 different scalping rules that I use. Some are going to be personalized to my own strategy, and then some are going to be generalized that everybody watching this video could implement. And I'm confident it's going to let a light bulb go off in your head so you could start using these little tricks and tips and start seeing more success while you're scalping. In my opinion, scalping the markets is the most rewarding strategy that you could use. It is also the easiest, yet the hardest to learn. Easiest meaning if we are a day trader capitalizing on a short time frame, maybe a 30-second, maybe a 5-minute, maybe a 10-minute type of trade, is the easiest way to make money and not overexpose ourselves into the market on daily fluctuations. Before we get into the rules, I'm going to post a link in the description below for my Instagram at Ameritrade. I definitely recommend everybody to follow me on here. I post daily trading recaps along with very good trading tips and tricks that I guarantee you're not going to find anywhere else. The link will be in the description below. You're missing out if you're not following me on there. But now let's get right into these rules. In order to be a very good trader in general, even a scalper specifically, you have to be extremely persistent in your trading. Persistence is not giving up after losses, not giving up after setbacks or failures, and being persistent enough to believe in yourself that you will figure it out, you will build an edge, you will start seeing profits, and you will be consistent. If I didn't believe in myself and I wasn't persistent after loss after loss after loss, when I first started out trading, I've been doing this for 7 years now, and I lost in about my first 2 years. In those 2 years, if I wasn't persistent, let's just say I gave up or I threw in the towel and I thought that trading wasn't right for me, we're going to go through those stages. But the most successful ones are the ones who can bounce back after those failures without losing enthusiasm, snap out of it, and be persistent. I'm the trader that I am today because I have years of experience built upon each other that I gain the screen time, I gain experience, I know what works for me the best, I know what doesn't work out for me. You could only gain this by being persistent, building screen time and experience, having a strong foundation, and then scaling up on that. I have progressed significantly over the years. Every year I'm getting better and better and better. I'm improving my mentality, I'm improving my strategy, I'm improving my system, and I'm scaling up to make more profits. It might not make sense for you in the first month, the first 6 months, the first year. It's not going to work out for you right away, but you have to be persistent to improve on a daily basis, both behind the screens and mentally, because the mental game plays a big part, especially if you are scalping. With this in mind, I truly recommend everybody to start small. I don't care if you have $1 million in your account. I don't care if you have $100,000 in your account. Start small. I'm going to post a screenshot on the charts right here. Pause the video if you want. Read this through because it's very, very vital. I recommend everybody to start trading with 1 to 3 contracts depending on what instrument you trade, being consistent until you've built your edge, and then you could start to scale up. How do you expect yourself to make, let's just say, $1,000 a day? How do you expect to make that amount of money if you can't even make $10 or $20 or $50 consistently on a daily basis while you manage your risk? The problem with a lot of traders, especially scalpers, is they overexpose themselves to the markets, both on a time basis and a monetary basis. And the more times we spend in the market with a large amount of money with no edge, the greater the chance that we're going to lose it all or lose a large chunk of it that's going to affect our future results. So first, prove to yourself that you can be consistent trading small size. And then once you are consistent for, let's just say, 1, 2, 3 months, then scale your trading up. You make more money not by working harder, but you make more money by scaling your size and following the same process. It is vital for you to stick to one trading strategy. The common theme I see with a lot of traders is they try a strategy out for maybe a week. They don't see success with it, maybe 2 weeks, and they think that the strategy sucks, and they throw in the towel on that, and they bounce back from strategy to strategy, thinking they could find the holy grail, something that's going to work 100% of the time. And by them bouncing back and forth, they're pushing themselves back so far in their trading that it's going to be very difficult to get over that little hump that's going to push you to be profitable. If you bounce from strategy to strategy, you are going to form such bad habits that are going to be very, very difficult to remove from your trading once you develop these bad habits. So if you're new, or you're just getting into trading, or you're slowly starting to build an edge, do not develop bad habits by jumping from strategy to strategy. Focus on something that maybe you've got inspiration from somebody else. Could be myself on YouTube, could be some other trader, but make sure you're following someone that has success, that has a strategy that works out for them, and then tweak it or bend it a little bit to fit your own personality, that you can conform it to yourself to build your own strategy and your own edge and your own system. Also, those who have been following me know I trade strictly off price and volume. I do not use any indicators besides VWAP. I stick to supply and demand zones with price and volume analysis. That is my edge. That is my strategy. That's how I trade. That's how I have success. So if you use indicators, I'm not going to bash them. If you can come up with a strategy or something that works for you, go for it. But true organic price action is what truly moves the market. And in my opinion, building bad habits is easier to do with indicator-based trading. A lot of traders' screens, when they first start out, look like this, and it doesn't give them a true picture of the market. They try to find that holy grail, and it's more noise in their trading. Believe me, price and volume analysis is all you need. All you will ever see on my charts is a supplier demand zone or support resistance key level along with VWAP. And I recommend every beginner trader to learn it that way. It might be the most difficult, or it might not make sense for you, but it will once you build that foundation and be persistent in developing your edge. Now, it doesn't matter what strategy you have. You could have an indicator-based strategy. You could have a price and volume-based strategy. You could be a scalper. You could be a swing trader. If your emotions suck, you will never, ever be a profitable trader. In fact, if you don't have a very good system, or you don't have a solid edge, yet your emotions are excellent and great and you can control yourself, you can still be a profitable trader without a good trading strategy. So leave your emotions out of trading. If you trade based off of emotions, you will never ever see success consistently. You might take one trade that are good, you make money on them, your ego goes through the roof, but I guarantee you by next month, you're not going to have any money in your account. It's going to be depleted. You're going to destroy it, because emotions is the greatest enemy for any type of trader. Hesitation, fear, greed, having no control over the future, having fear of the past, these are all emotions that you cannot be trading with. Your emotions will let you see what you want to see, hear what you want to hear, and feel what you want to feel. Humans will always have emotions. We can't completely get rid of them. We're human. Everybody's got them. But we have to block out the negative ones that influence our decisions in the market. If we make decisions based off of emotions and not the chart, believe me, it will be very difficult for you to see profits. And that was my biggest mistake when I first started out my first 2 years. Now, for me personally, and the traders that I know on Wall Street, family and friends, out of the ones that scalp, they hardly look at charts to make a decision, and they do all their analysis confirmed by some type of order flow. Now, there are many different tools you could use, but they all stem from organic price action by reading price and volume and the orders coming in. Who is showing interest? Who is passive? Who is aggressive? Is there a large seller? Is there a large buyer? And we can spot all this, confirming it with order flow. Time and sales, level 2, platforms like Bookmap, volume profile, delta, market profile, footprints, all different tools which will show you the same information visually represented in a different way. And I'll be honest, I cannot scalp without any type of order flow analysis. I need to confirm my trades, making sure I'm on the same side as buyers and sellers via order flow. If I'm looking along something, let's just say off of a demand zone, or I'm playing a key level breakout, I want to make sure there are other traders buying directly after me and also before me to confirm my trade. I want to be in the mix with momentum. We cannot truly see that enough amount of information strictly or solely off of a chart. This is where order flow comes into the picture. And in my opinion, to scalp proficiently, I personally need to have some type of order flow analysis. And out of all the traders that I know who scalp on Wall Street, I'm talking 8 figures a year traders, all use some type of order flow analysis. In my opinion, it is vital. And another rule, which is personalized to myself, a lot of people might not agree with this. I know I'm going to take a good setup directly after I enter. This also goes back to the type of trading back in the pits, back in the day in the 80s. 95% of my trades that I have success with and that are profitable work out in my favor right away. Why this is I time the market properly. If I'm looking to play a bullish position and expect the market to come up, I want to make sure there are people buying directly after me. If I'm scalping, my scalps last a few minutes. I want to be able to capitalize on momentum in the market and a short-term price movement. When we see this, 95% of my trades work out in my favor right away. This was a trade that I made $8,200 on. It was about a 10-minute scalp. And if we were to look at my running P&L, this is showing me my profit and loss as I was in this trade. Directly after I entered this trade at 9:42 Eastern, the market immediately worked out in my favor and my running P&L was never red. Now, I'm not going to say my trades never go red on me or directly after I enter, I'm not in pain or I'm losing on it immediately. But the best setups that I make the most amount of money on and have the most success with, I time in such a good manner that buyers are buying after me, buyers are buying before me. I get in at the best moment that the market does work out in my favor 95% of the time right away until my target hits. This was a $1,600 loss on the S&P 500. Directly after I got short, the market bounced and reversed upward. My running P&L was never ever green, and this was a setup that did not work out right away. I followed my plan and I stopped out when my stop loss triggered. This was a setup that I made money on. I was profitable on it. However, if we look, directly after I entered, the market pulled back on me. And if we were to look at my running P&L, there was some red in here where at one point I was down about $1,900 in about the first 5-10 minutes of this trade. It moved up. We didn't really work in my favor right away, and it was a choppy, consistent grind up before my target hit. Yes, I made money on it, but this is the one instance where I didn't time it right and I wasn't trading where there was momentum in the market. If you are scalping, you want to make sure you see momentum in the market. Now, to take high quality setups, we must know market context. What I mean by this is we need to know where buyers are factored in at, where sellers are factored in at, what's the trend, what are conditions, how is volume, how is volatility, and overall get a feel of what the market's doing. In this case, on a higher time frame chart, the S&P 500 is putting in higher highs, putting in higher lows, and the overall short-term trend is uptrending. So what this tells me is now dips into demand are going to work very well, and the breakouts above key levels targeting supply is also going to be a setup that I'm personally going to be watching. That's going to give me a high quality opportunity. You always want to make sure you understand the context, and the greatest advantage of a retail trader is sitting sidelined if the market doesn't make sense. If you can't read it properly or you can't get a good feel on it, you do not have to trade it. To speed up building our edge, along with having a strong foundation from others' courses, others' videos, books, we need to have that strong foundation from those resources. And I wish I had somebody like myself when I first started out. It would have sped up this learning curve. If you record your screens, you track your trades, you journal all your setups, you will start getting a better feel on the market. You'll slowly start developing your edge. You'll know what works out for you the best. You'll figure out your confirmations. You'll figure out your setups in a more approachable manner. There are features like on demand on ThinkorSwim, a replay feature on TradingView, replay features on Bookmap, even free platforms like OBS. Record your screens, see what the market does at your levels, see how you could have traded it if you didn't trade it, or if you did trade it, figure out what you did right, what you did wrong. Track all your setups. Maybe you suck at bounces off demand and downtrends, or maybe you lose the most on, let's just say, shorts at supply in uptrending markets and playing a reversal and stepping in front of the momentum. So you could only figure out this by collecting your data, journaling, tracking, and recording. You guys need to stop predicting. Nobody knows the next outcome in the market. I see a lot of people coming up with a plan and they say, okay, Tesla is breaking 180 bucks. Let me play puts below 180. Or Apple's breaking above 120. Let me play calls above 120. That's predicting. Nobody knows the next outcome in the market. I can't wake up one day and say, okay, the market's going to sell off, the market's going to rally. That's predicting. I don't know what I'm going to do beforehand. Instead, you need to react to what the market gives you. Stop predicting and start reacting. If you have, let's just say, SPY below 4,000, wait for SPY to hit 4,000 and react to what the market does at that level. If it gives you a clue or a signal for you to get short at that level, then take the trade. But if we come into that level and you don't see anything or nothing's indicating buyers or sellers, then just don't take the trade. Many traders try to predict, and you cannot predict the outcome of the market. It's impossible. Warren Buffett can't do it. I can't do it. The best traders on Wall Street also can't do it. But they come up with levels of interest and they react to those levels of interest. It's as simple as that. And you need to play defense over offense. If you can preserve your capital, it will grow in due time if you have an edge and you manage your emotions. I'm sure you heard in the NFL, NBA, defense wins championships. Same thing in the market. If you can play defense, maybe you're in a position and a red flag occurs. Maybe you buy it off this demand zone, the market rallies, hits VWAP, let's just say, and maybe a huge seller steps in and the market starts moving lower. Get out of that position. If your analysis was correct, maybe your target didn't hit, but the market presents a red flag, you're reacting to the information that it gives you. There's certain information that we do not have prior to the market being open. We only get it when the market is open, and that is us reacting to that information and putting risk on the table. And also, if you're scalping, you want to make sure you have targets that are realistic, that can possibly trigger and prove your analysis correct. If we're buying the market off of this demand zone over here at 39.50, if we're scalping, I'm not going to have a target 100 points away if the average range every day is 30 or 40 points. You need to have a realistic target that where your analysis is correct and where the market can reject. If you've learned anything from this video, I would really appreciate dropping a like if you've made it this far, subscribe to the channel, and also check out the links in the description below. I offer a very in-depth and educational course. It will help speed up the learning curve with the market. The prices on the website are currently discounted, and directly after Black Friday, I plan on raising them back up to original prices. But I'm going to end it on that note. Peace out.